Well, we've got a short reading here to cover called The Basics of Portfolio Planning and Construction. And this is really introductory. It sets up for what you're going to continue to study more at level 2. And then when you get to level 3, which is all about, hey, take everything you learned and talk about risk and return and constructing a portfolio and all that sort of things. But we get some of the terminology and some of the basics, as it says, of portfolio planning and construction, including the investment policy statement, which is a key part of this. So the investment policy statement, what does that do? Well, it identifies client objectives and constraints. So when there's a manager and a client, manager's managing the client's money, putting together a portfolio, we want to have a clear statement of the objectives and the constraints. A clear statement of the client's risk tolerance. We don't want a portfolio that is not aligned with the risk tolerance, or the other side of that coin, risk aversion of the client. And it imposes some investment discipline on both the client and manager from having all this spelled out clearly. It identifies the risks that are going to be faced in this portfolio and deals with the idea that these should be appropriate for this client and this client's situation and risk tolerance. And finally, identifies a benchmark portfolio. When we've got an account manager doing active management, that is selecting securities in different proportions from the benchmark in hopes of outperforming the benchmark, we've got to be able to measure that. Because if we're going to pay for active management, we need to get returns greater than the benchmark, because investing in the benchmark, passive management, has very, very much lower costs. So what are the major components of an investment policy statement? Well, first off, a description of the client's circumstances. Age, okay? What goals? Maybe income, okay? Situation regards obligations and insurance and things like this. Then the purpose of the investment policy statement, that should be short and sweet. Duties and responsibilities of all the parties, let's spell it out clearly. And what are the procedures to update the investment policy statement and resolve problems? A problem might be something like deviations from the investment policy statement. If we see a deviation in the management from the investment policy statement, how do we resolve this? What's the procedure to get back to where we should be? It should outline the investment objectives and constraints, and we'll spend a bit of time on that here, the investment guidelines, the evaluation of performance, along with what benchmark is going to be used, and then one or more appendices talking about the strategic asset allocation, permitted deviations, rebalancing procedures. When we talk about the strategic asset allocation, the manager has looked at the situation and evaluated the opportunities in capital markets and determined the right allocation of different asset classes. So maybe large cap U.S. stocks, or international bonds, or small cap stocks, or whatever it might be. And so that's the strategic asset allocation. Now, in some situations, the manager can deviate from that in the asset allocation. So that's what it means here by permitted deviations. If the strategic asset allocation to equities is 40%, and the manager sees an opportunity, thinks that equities are really down, and a good time to buy them, their expected return looks higher, can the manager allocate more than this 40% in the strategic asset allocation to equities, or less than that amount in the opposite circumstances? And what's the maximum that the manager can deviate from this strategic asset allocation? And over time, as prices change, your asset allocations in market value are going to change. And so what's the procedure? How often are we going to rebalance this portfolio back to its strategic asset allocation? So the first part of it, investment objectives. Now, when we talk about objectives, we've got risk and return. We analyze risk and return together because there's a trade-off there. We can't look at a client's situation and say, oh yeah, well, you need $150,000 a year to retire. And you've only got this much in your account. So what we need is these investment strategies with a expected return of 18%. Well, as you can imagine, that might be a pretty darn risky strategy. So just because the goal is $150,000 a year and the resources come up a little short of what would provide that currently, and we say, well, you have to take all this risk. Well, no, that's not the case. We've got to consider risk and consider the return objectives, but also consider this trade-off between the two of them, and to get your risk situation in line with the investor's risk tolerance. Well, what affects this investor's risk tolerance? Well, certainly psychological factors. Some people just can't stand to see it go down, or if markets fluctuate 15%, that's just too much to take. Not much you can do about that. And then there's the personal factors or situation. The age, how long until the goal, right? If the goal is retirement, how many years until retirement? What's the family situation? Kids still to put through college, okay? Family members that need additional support on an ongoing basis, and existing wealth. Typically, if you're wealthier, you can take on more risk. You can take on more variability from year to year without really negatively affecting your situation or your psychological reaction. Insurance coverages, cash reserves, and income, of course. Higher income gives you the ability to save more if necessary, if things take a downturn. So all these factors go into determining the investor's risk tolerance. Now we can break down this risk tolerance into the ability to bear risk and the willingness to bear risk. This ability, this comes from your investment horizon, right? How long until the money's going to be used or until you anticipate using the money, what your insurance coverages are, you know, whether you have maybe disability insurance or not, current and expected levels of income, current level of wealth, and these financial responsibilities. So that's kind of all stuff we can analyze, the ability to bear risk. Then we have the willingness to bear risk, and this depends on the attitudes about risk of the investor and also the investor's beliefs about what risk they are undertaking by getting into equities investments or an option strategy or whatever it is. Well, as a manager, you might run into a situation where the willingness is greater than the ability. So the investor is in a situation where he really shouldn't be taking that much risk, and yet has the attitude of, oh yeah, this variability doesn't bother me. What? Me worry. Okay. Well, in this case, the advisor should really go with the ability. The fact that the client has a great expressed tolerance for risk and uncertainty shouldn't change the situation, that the advisor has a duty to advise them at least conservatively enough that it's not going to turn into a disaster. But sometimes we'll get to a situation where the ability to bear risk based on those factors we listed is greater than the willingness. Think an investor's kind of a fraidy cat for whatever reasons. Okay. Well, in this case, the manager can educate the investor about the investment risk. Maybe they think they don't understand how diversification reduces the risk that you would have in single securities or a concentrated portfolio. And so just education based on past returns, past market outcomes, okay, might be appropriate. But it's suggested that you don't attempt to change the personality, these psychological characteristics that have made this investor a little bit nervous with a very low risk tolerance. Maybe he had a parent that invested too risky, or remembers something that happened during the last financial crisis that really was devastating to some people, and this really sticks with them, and there's not a lot you can do about that, and you can't really change your client. You've got to put your client into a portfolio they're going to be comfortable with over time, or guess what? They're not going to be your client for that long. So those are our objectives, risk and return, R and R. Now we're going to look at the constraints. One is liquidity. Potential need for cash, either for unexpected things or planned needs in the future. These are going to put some restrictions on what you can do in the portfolio as far as risk and return goes. Then legal and regulatory. Now this applies more to institutional investors, but if it's an individual investor, we certainly are going to look at things differently. If it's a tax-deferred account for retirement, like an IRA, or a personal taxable account, well, they've got different legal and regulatory guidelines that go with those. Our other constraints, time horizon. How long until the proceeds of the investment will be required? And the general thinking here is that the longer the horizon, the more risk the investor can take on. If they're saying, well, we're saving for a house, we're going to buy a house in 2 years. Well, you're not going to go into very risky investments over a two-year horizon. Tax concerns, I mentioned, is the account taxable, tax deferred, or tax exempt? So I guess earlier we were talking about legal and regulatory, so that might be like to differentiate between the two. That might be things that are permitted holdings in your personal account, which are not permitted in a retirement account, for example. And then we can overlay the tax concerns on top of that. And lastly, the unique needs and preferences. And that's really anything that doesn't fit into the above categories. Perhaps the investor has preferences for investments that are green, good for the environment. Perhaps the investor doesn't want anything to do with tobacco stocks or gun stocks, no matter what. This is where those things would show up in unique needs and preferences. Now, when I took the CFA exams, and especially right on into level 3, where we had to construct portfolios and deal with all these elements of an investment policy statement, we always memorized this as RRTTLLU. Kind of rolls off the tongue, doesn't it? So these are our objectives, risk and return. Okay? And then we had tax situation and time horizon. We had liquidity, and we had legal and unique. So RRTTLLU, that'll help you check off this list. So I mentioned the strategic asset allocation. So we look at the risk and returns and correlations. Now, just as we look at a portfolio of stocks and get diversification benefits and can figure out the optimal point on the frontier, we can also do that same thing with asset classes using their expected returns, standard deviation of returns, and correlation of returns, and come up with an optimal portfolio, an optimal allocation across asset classes. And in general, correlations of returns of assets within an asset class should be relatively high, like large cap U.S. stocks. Generally, they tend to move together and have higher correlations. Between asset classes, we want those diversification benefits, which we know are higher when correlations are lower. So we want to identify asset classes that perform somewhat independently, so correlations are low, and within an asset class, put those assets that tend to move together, tend to have returns with reasonably high correlations. And here we've just put an example of a strategic asset allocation. And no particular reason for these numbers here, but just to give you an idea of the types of asset classes that we're talking about. Now, it could be as simple as stocks and bonds, But it could also be more complex like this one. We've got what? Large cap U.S. equities, mid or small cap U.S. equities, international developed market equities, emerging market equities, high yield bonds, U.S. bonds, international bonds, real estate, and hedge funds or some other sort of alternative investment. So here's an example of a strategic asset allocation that you might see in an investment policy statement. So we could use, as I said, the risk, return, and correlations of these asset classes to construct an efficient frontier of asset classes. We'll use the objectives and constraints, RRTTLLU, from the IPS to select an optimal portfolio. That's our strategic asset allocation. And as we spoke of a little bit earlier, we could overlay a tactical asset allocation on this. Now, that comes from looking at these asset classes and say, well, I think this really shows opportunity, or boy, this asset class is crowded. Its price has been going up. It really looks like maybe we should back off on that one a little bit. And so this is that overlay on the strategic asset allocation of these tactical moves. Another approach to portfolio construction is risk budgeting, where we say, okay, overall we're going to take this much risk. And then we can say, okay, where are we going to take that risk on to best advantage? So some of that's going to come from your strategic allocation. And an overlay of tactical allocation may add a little bit more risk, a little bit, hopefully, possibilities for better return there, but also taking on risk. And then within an asset class, do you want to stay with the benchmark weights for all the stocks in that, or all the securities in that class? Or do we want to deviate from those weights and try and add additional profits from selecting and overweighting individual securities? And I guess if we're going to overweight some, we'll be underweighting some others. So the idea of risk budgeting is, well, we're going to take on this much risk, and this is going to be from strategic. Our tactical allocation, our tactical overlay on the allocation will add this much more risk. And given that we're willing to take on this amount of total risk, that allows us to take on this much more risk for security selection, deviating from the benchmark weights within an asset class.